All right, we're live, sis.
Yay! Good morning, Chi Chi fam.
Good morning, everyone. Happy Thursday. Oh, I'm still waking up. For the past week, it's been, I don't know, I just feel like we're so tired for the past week.
Well, you've got that warehouse. You're doing a whole bunch of things, Chia. It's finally catching up to you. You're finally human. You know.
My little guy, too, man. Oh my gosh, he's got so much energy.
Isn't that amazing?
Oh,
Once
I don't,
we all had that bundle of energy. Can we just bottle it up, sell that to people
yeah.
like me?
Uh-huh, for reals, for reals. Oh my god, yeah, he has so much energy. But But yeah, how's it going for you? How's the family? How's business? All that.
Oh, Chia.
Oh, I just lost you. Okay, I can hear you now.
Can you hear me?
You're cutting out.
Can you hear me okay? Let me
Mm-hmm.
check my internet, which is
Yeah,
weird.
okay.
It should
No
be.
worries. While you're doing that, everybody that's on right now or later for the replay, if you guys have any questions or so, don't forget to ask them in the live chat or the comment section. So that way me and Lisa could answer all of your questions for you. And then yeah, we'll go from there. And if you guys know anybody that's looking to buy or sell or anything like that, give us a ring. Um for the past week, I've been getting a lot of people reaching out to me about questions on whether they should sell, whether they should buy, all of that. So you can heck and tell that the market is picking up. So I
It
am
is.
starting to see that right now. Yeah.
It is, but we're heading into. I mean, we're, we've passed quarter two already, almost in the middle of quarter two. That's when everybody starts seeing that because school gets out typically at the end of May, beginning of June-ish. Everybody's trying to get ready and stuff. I have a lot of people actually from our area moving to Fresno, Visalia,
Hmm.
Madera, going to Central California, where it's a little bit more affordable and whatnot.
Yeah.
And the hard part is they're teeter-tottering between selling here and having to register and don't have an address to register for their kids in school over there. So that's been a challenge for them.
Yeah. There's a lot going on. What's up, Jim? How's it going, man? Yeah, I've noticing that too. People will call me from like Fresno, Merced, Stockton, um, and they're going a little bit like at least an hour to 2 hours away from Sac
Yeah,
because that's
yeah,
where the prices are kind of down like 100K
yeah.
for like the same house size.
I know. It's well, see, that's the thing. That's what Bay Area feel about Sacramento home prices.
Exactly.
I
Pretty
mean, every
soon,
market is
everybody in
similar,
Merced and Fresno's gonna be like, "Hey, Sacramento, stop coming here."
right? Right? It's like, oh, those darn Sacramentans.
Yeah, for reals. Jim says, been looking for a place within a 2 hour radius from San Diego. Is a market there still fairly competitive? Yeah, man. If you're 2 hours
Very,
away from
very.
San Diego, then you're coming to Sacramento. 2 hours away from Sacramento is like again Merced, Stockton, Fresno, that area, or in the mountains. Um, so yeah, 2 hour radius, man. You're gonna probably be still in that competitiveness.
Yeah, I
But
mean,
it
San
also
Diego is prime real estate. It's not as crazy as it is in Orange County or Los Angeles, and it's right there close to the beach. The weather is great. If the market does slow down there in San Diego, I would love to retire there. So I'm looking myself.
Yeah, it's crazy right now. It's still pretty crazy. Sacramento is a very unique place because we're in the middle of everything. Bay Area is like a couple hours away. The snow is a couple hours away. The beach is like right there.
Yep.
So we're pretty close to everywhere. Plus, we got downtown Sac. Did you know that downtown Sac was nominated as one of the top 5 like street food areas?
What?
That's what I'm saying. I'm like,
Really?
really? I normally go to LA for all the street food, like
I
Sacramento,
think so
downtown,
too.
downtown Sac, actually, downtown Sac.
I'm gonna look that up.
Yeah, yeah, look that up. But while you're looking that up, let me just kind of go over market updates real quick. I'm pretty sure everybody wants to see all of that. So let me share my screen and let's look at this yummy chart. Yummy. Look at that inventory started to go up. Let's see. Yep. So from last week, inventory went up 2%. New listing is down 15%. Sold home is down like 0.5. Pending home is up 10%. This is from last week. Now, last month, look, this is what I like to see. 8.6% increase inventory from last month. New listing is up 14% from last month. Sold home is up 9% from last month. Pending homes are up 33% from last month. Now, same time last year, inventory is up from last year 33%. New listings up 41% from last year. Sold home is up 1.8% from last year. Pendings are up almost 30% from last year. Everything's up. The market's moving. The market's moving.
That is actually really good. I think people are just,
Yes.
it's not just the home pricings that is high, but cost of living, everything. Everything's starting to get really super high here.
Everything's going up, and I think started April, minimum wage right now is like $20 an hour. Isn't that crazy?
It is crazy and it hurts the business owners too. And a lot, I mean, it's a controversial.
I Does it really hurt the business owner though? I feel like it's honestly hurting everyone, not just the business owner, because
Yes,
they're gonna have to extend that expense into the menus, right? To what they're selling, the to the services that they're providing. So the consumer, they're gonna be paying that on the back end. That's what I think a lot of people don't really understand. So
I totally
yeah,
agree. Totally agree. It hurts the business owners, but it hurts everybody in the long run because
everyone.
just the goods that's being sold is going to have to be higher to compensate for that margin that the business owners are losing. And we're talking about small business owners. We're not talking about like the big chains and
Yeah.
whatnot. You know, they're not going to be as affected as much because they have the capital to actually automate a lot of things. You know, you go into McDonald's, you go into a lot of the big chains, you'll see a lot of more automation. So it
Yeah.
didn't help. It actually messed up a lot of the jobs out there.
Yeah. And we're gonna talk about that on another day, another topic, another day. But let me finish this real quick. Average price per square foot is down from last week, 2%. But comparing to last month, it is up 1.2%. 346. If you guys are wondering, this is $346 per square foot. Okay, so normally you just times this by the square foot of your home, and that's the average right now. Okay, but that doesn't mean that's gonna go for every home though. Remember that price per square foot. Kind of take that as like a grain of salt. What you really want to look for is comps. Okay, comparisons in the area within a quarter mile radius. Okay, average days on the market is up from last week by 2 days. Okay, not bad. 2 days, which is still not a lot, but yeah, 2 days. But from last month, it is down like 11 days on average. And look, from last year, it is down 20 days. That's how fast homes are going. That's how fast homes are going. What's going up, Tor? Good morning. Good morning. Thanks for joining us this morning. Any questions, just let us know in the live chat below. And then we will answer them accordingly. Okay, those are average days on the market. Let's go to average price sold and listed. Now, active price on average is up from last week, 1.3%, but sold price went down. Excuse me,
Oh, interesting.
6%. Yeah, from last week, 6%. But I always look at month to month, because we're still like kind of in the mid-April. It hasn't really fully ended yet with all the data. Because look, if you're looking at this comparing last month, it's up 1.7% sold price on average. And then look from last year, 4% sold price. I don't care much about active because that's just list price. That's not sold
Yeah.
price. So look here, y'all. Like on average, $603,000 on average for the last this month so far compared to last year. What's up, Kamara? Good to see you this morning. Good morning, good morning. Happy Thursday. We need to have him come back on the show again and talk about insurances.
Yeah, I've seen so many changes, and it's been, Chris from Camera Insurance has actually been really, really good at getting the policies back to us as quickly as possible. And there's just so many issues across the board every time we're trying to get that. And it's like, hey,
Yeah.
I have my agents asking me, hey, can we shorten the contingency? And I said, we can absolutely shorten that part. The lowering is not the problem. Getting the insurance and whether or not we can get that in a timely manner seems to be a tougher thing right now. But Chris has been doing really, really well for us. So thank you so
Yeah.
much for that, Chris.
Yeah, he's awesome. Yeah, maybe one of these days we'll have him come back, give us an update. It's been a minute. All right, let's go over months worth of inventory. And oh, no change. 1.4 months worth of inventory. You guys know what that means. Anything under 3 months worth is a seller's market, and homes are gonna go like that. Prices are gonna get pushed up. That's just the nature of the market right now. Until we get more inventory in the system, more homes for sale, more sellers putting homes on the market, it doesn't really matter as long as anything contributes to the inventory. The market's gonna be the way it is. Okay,
Yeah.
people's gonna keep bidding, and price is gonna keep going up. So just FYI, if you guys are wondering how the market's gonna be like for buyers or sellers, just look at inventory. Like a big determining factor right now.
Right. Right.
Chris says, "Thank you. The insurance market is rough."
Yep, we've been hearing that across the board with all of our insurance agents. And it's hard. They don't control what the guidelines change and everything. And right in the middle of an escrow, I've had situations where it's like, oh my gosh, they just changed this. We have to get this. We have to get the water leak detector and everything like that. And it's not just farmers; it's a couple other ones as well, right? And then you
Everybody's
know,
trying to implement that now, huh?
correct, and it's getting higher and whatnot, which changes the debt to income ratio for our clients. And on top of that, with the interest rates still continuing to rise, again, it's continuing to rise, right?
Mm-hmm.
I said that from the last time. Hey, don't count your eggs before they're hatched. The Feds keep saying it's like, yeah, we'll lower it, and now they're like, nope, there's no need to lower it, even on an election year. So we're not going to see that. I hope that we can. I have so many people on the fence waiting to refinance, but it's still not there yet, guys, and it actually went up already.
Yeah. So let's go over the rates as of today. Look at this.
Right.
Conventionals at 7.4%. 15-year fix is 6.8. Jumbo is 7.6. Adjustable rates, we're not even going to talk about that. 7.3. FHA is at 6.8. VA is at 6.8. So it's gone up slightly, everyone.
Hmm.
It's gone up slightly. So if you guys are in the escrow right now with a home, I'd say um don't gamble. Rates are very volatile right now. You can't really predict what it's really gonna do. Um, because if you're waiting to lock it in, um, one is the seller's gonna be willing to extend escrow if that happens to give you more time to lock or find a more favorable rate to lock. And two, is it gonna go up? And then now it's gonna make your payments go up higher versus if you would have locked it in sooner. So it's a gamble right now. So just listen to the advice that your lenders are giving you, your loan officers, such as Lisa, because they live and breathe this. They're gonna know what's better for you, and then just listen to their advice on what they say regarding your rates, because um, you don't want to shoot yourself in the foot.
You really don't. I mean, I've seen some situations, especially if you guys are right there on a cusp of qualification. And some of you guys might not even know that you're on the cusp of qualification. I usually, when I do an assessment with my clients, I'll tell them, it's like, hey, if you are an FHA allows you to have up to 57% debt to income ratio. But if you're right there on 56.5 or something like that, okay, don't gamble. I mean, you shouldn't gamble anyway, not during this market, but ask your loan officer, say, hey, how much wiggle room do I have? Okay. And if you don't, I highly don't recommend it, especially if you're about to remove all your contingencies and whatnot, and all of a sudden you see the spurt goes up. To the outside looking in, it looks like, okay, from last week to this week, it went up roughly about a 1/4% across the board and everything. It may not be that big of a deal when it comes to percentage wise, but it may be a pretty big deal when you're looking at home prices that are in the 600 to 800 range, where that could be a difference of a few $100s. Okay.
Yeah.
So be careful about that.
Yep, you guys bet that is the case right now. Not just for like a small amount of buyers, for a lot of people. Okay, this is happening across the board. So we're seeing every day. That's why we're bringing it to you guys and we're mentioning it because it's pretty important to look at. But that is the market update for the mortgage rates and for the housing market here in Sacramento. Okay, I want to go over my topic with you guys. Gosh, I think a lot of you guys are gonna be interested about this. I'm just gonna share a quick video again. How are you guys liking the lately topics of us just kind of responding to videos, TikTok videos, YouTube shorts, and all that? How do you guys feel about that? If you guys have videos you guys wanted to talk about, send it to us. You know, on Facebook or Instagram or YouTube. Like, send us the link. We'll talk about it. Um,
Yeah.
Sometimes these videos are shared with us by our clients, and then it's we're just curious about it too, and we just want to talk about it and fact check it because it might not be true. So I'm interested in seeing this with you, Lisa. Let me just share this screen real quick.
I'm excited. I don't even know what it is, guys.
Oh, you will. Here, let me just. All right, can you see that?
Yes.
Okay. You don't need credit to buy a house. Let's just listen to the video.
Ooh.
Okay. Okay.
Actually do not even need a credit score in order to get a house. And I say that with utmost confidence because I've done it and thousands of people have done it. It's called a no score loan through manual underwriting.
What is the no score loan?
The
Lisa,
no
I've
score.
never heard of that before.
They do exist, guys. They do exist. Here's the thing with the no score. That means you have no score. Just because if you have not great credit, it's not like they're not going to give you a loan. They're going to give you a loan if you had no credit at all, ever. Okay? So for those of you who are like, "Oh, okay, well, my credit's bad. Why don't I just go with the no credit and then they won't count it?" Not every lender does that. It is a risk for them to do that. And just because it's no score doesn't mean it's necessarily no score. I want to see what this guy says. Okay. And that actually is a per lender. So if the lender's going to keep their loan, they're not selling it to Fannie Mae and Freddie Mac. Okay. They're going to hold on to it and everything. They may have products that could help with that. And again, no score really means no score. It's not like if you had
So if you
bad,
have bad credit, it's considered
can't use
a
it.
score.
Correct. 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 And no score doesn't mean that, okay, well, I don't have a score at all. It's more of like, okay, they're going to look at your utility bills, your rental history. So if you don't have that, you're living with mom and dad and everything like that, it may not always fly. This is a per lender type of thing. Okay. This is not a Fannie Mae Freddie Mac guideline. This is a per lender thing. So if there's like, if let's just say, for instance, they want a certain amount of clientele that has that, and keep in mind, anything that's a little bit different than the norm, the interest rate is going to be typically higher because it's a higher risk.
Yeah, this makes perfect sense. This is like a loan for like my mom. She doesn't have a
Yeah.
credit card. She doesn't have a car loan. She uses cash for everything. So this is like a perfect example for someone like my mom. But I feel like it's just me speculating because I don't know too much about this industry about that. But I'm assuming these type of loans are only utilized during like a slow market. So a buyer's market.
Yeah, I haven't heard of it for a while. It's funny because like I probably about 5 years ago, there was another client that came to me, and they had a tough situation, and I knew one of my friends from um, another lender was advertising this, so that's how I found out. I found out because they shared with me. I was like, oh, these are the stipulations. It's not as easy that it goes. We don't have that in our department. Just again, we've been around for quite some time and everything like that, and we don't do those type of risks. But I'd like to hear him say, the guys from Ramsey show, I can see it from the background,
Yeah.
which again, I really like Dave Ramsey. He has some really, really good advice. Some of them, though, I would have to say is not for everybody.
It's not. It's kind of like anybody out there that's giving advice, it's their advice is only going to cater to like a certain pool of people. Not everyone's going to be able to apply it in their own lifestyle because it's not going to fit everybody's lifestyle or goals and dreams. So, yeah, I was very curious about this. That's why I was like, oh, I can't wait to show Lisa this. But like Mick is saying, what class of lender would be able to give these loans out? Where we could find that? Like
I don't
who
even
would
know, but
typically have these type of loans?
I don't the one of my buddies who actually used to work at a lending institution that advertised that they haven't advertised it in a really, really long time. I don't know if they even have it anymore. So if I no credit, I'm gonna look it up right now. No credit mortgage
It's
loans
kind of I feel
lender.
like it's also kind of like renovation loans. I sometimes you hear these gurus talk about it, about finding a home that needs to be worked on, just get a renovation loan and all of that, 2 or 3K loan, that's what it's called. 2 or 3K loans, I feel like it's mainly used during a buyer's market because right now in the seller's market where homes are going quick like that, um, remember a seller still has to accept that loan because it normally takes months to close versus if they have over 20 offers like what we're seeing right now in this market, and other offers are not 2 or 3K loan where they could close in 20 days or less. They're gonna probably choose a 20 days or less offer versus yours that's gonna take a couple months. And
Right.
contractors have to be approved by the banks, all of that. So I feel like those type of loans, including this one, are meant more for a buyer's market where it takes 3 to 6 months on average to close. So it's already taking that long. Why not entertain that type of loan? So
Right.
just my 2 cents. Did you find it?
Right. I did. I mean, I found it on Lending Tree. I had to go down to a second page on Google
Lending
just
tree.
yeah, Lending Tree. And Lending Tree is kind of like the almost
It's kind of like a hub.
yeah, almost like the Google for if you want to find anything on lending and whatnot. So get a cosigner. One of the things that says the 4 steps that you can get a no cost or no credit score loan. Before I go into this, let me go into what you're saying about the 2 or 3K loans. I've done 2 or 3K loans before. I've yet to ever do one that actually accepted a no credit score, by the way. Okay. Now, the other no credit scores is private money. Okay.
Yep.
And hard money. They used to not require that. But in a very volatile market like it is right now, most of my hard money and private lenders are requiring it still. Okay. And those interest rates right
Somewhat.
now is roughly around 12 to 15% right now. So if you want to go that route, absolutely.
And
There's
the interest only.
they're interest only, and right
And you
now,
gotta
most
pay
of them,
back in 2 to 3 years.
2 to 3 years, there's a balloon payment. What that means is it's interest only. And in 2, 3 years, if you can't pay that back, they will start the foreclosure process. Okay. And you have to pay that back in full. So for those of you who are thinking this is a great idea, you're buying a $500,000. If you're not having a way to get that $500,000 within 2 to 3 years, I mean, like refinancing it back, increasing your credit score to be able to do that, increasing your income to be able to do that, then it is tremendously risky. So here's what it's showing on Lending Tree. get a cosigner. Whether you have poor credit or no credit at all, adding a credit-worthy cosigning to your mortgage loan can be one way to improve your approval odds. It can improve your odds as far as adding more income to your debt-to-income ratio. But typically, lenders who look at credit will look at the average credit of the person that has the lower of the two. So that's not going to help you on credit-wise. Okay? Have a large down payment. Yes. So if you have a larger down payment, your debt-to-income ratio decreases a little bit, and that's going to help you because your monthly payment is going to be a little bit lower. That's definitely going to help you, but it has nothing to do with the credit portion. So, I'm not sure why he said this is the 4 steps to having a no credit. Go through a manual underwriting process. Okay. What a manual underwriting process is when you have a situation that's a little bit outside of the norm, the underwriter will manually underwrite this instead of going to all of the regular channels of the automated system. Okay, we have an automated desktop underwriting system that will determine whether or not you qualify based on all of your credit, based on all of the criteria that we punch into the system. A lot of times, you're going to have a situation where you're kind of out of the norm. So the underwriter manually will determine, hey, your credit's not all there. However, do you have other compensating factors? Are you putting like 40% down? Okay. Are you, in a industry that is growing? It is the only reason why you had a tough situation on your credit is because of a medical situation. I had a client a few years back that unfortunately husband had a heart attack, and he was in the hospital for quite some time, and a lot of his income was dependent on his overtime income. Now his income, his regular income, because he was getting disability income, was able to be counted, but we couldn't count any of his other overtime income. And therefore, it really, really hurt his chances of getting home at that time. But when we convert it into a manual underwriting, they're looking at it and they're saying, okay, even though your credit got hurt because he couldn't pay a lot of his bills because of his income decreasing, the underwriter was like, oh, this was the only reason why his situation happened the way that it happened. And he was only not able to pay his bills during the time that he was hospitalized, during the time of his recovery period. And they deemed that, yeah, he's completely fine. And we were able to get that loan for them. And that was a great situation. So that's what manual underwriting is. It doesn't have anything to do, well, I take that back. I suppose if lenders are doing this type of loan, they will look at the compensating factors when you don't have a credit score. They're going to look at, okay, well, what type of job do you have? Is it self-employed? Is it a company that you just opened 2 years ago and it's in an industry that is kind of a little bit volatile? It's an investment firm, something of that sort. They may not approve it.
Kind of reminds me of bank statement loans.
Yeah.
Or DSCR loans.
Yeah, but they still ask for credit, Chia. Those loans
yeah,
still
that's right.
ask for credit. Yeah.
Yeah, because I hear people getting loans to bank statement loans. And let me tell you guys, people, a lot of time those are the loans that are like what? Subprime, right?
I wouldn't call them subprime. I see where you're getting at, Chia, because it's like, hey, how do you not do your due diligence? Yes and no. Those types of loans, you still have to put a minimum of 20% down. Okay. Then on top of that, you do also have to have reserves. Depending on the lender, it could be anywhere from 6 to 18 months worth of reserves.
Yeah, they changed their guidelines on that a lot.
Right. The interest rate is the interest rate is actually higher as well. Those types of loans are great for investors whose debt to income ratio is typically too high because they have other properties, something of the sort, or they're self-employed. The bank statement ones are typically geared for self-employed people, where if you're self-employed and you write off everything, which you should, right? Legally, you're in the rights to write off whatever that you're allowed to write off. But if your gross income is $500,000, but you're writing off everything and now you're all the way down to $20,000, they're not going to look at that $500,000 no matter how high that gross is. They're only going to look at that $20,000 because you stated to Uncle Sam that you only made $20,000.
Yep.
Well, then if that's what you state to Uncle Sam, that's what the bank has to go by. So the bank statement loans is actually a really good one for self-employed people who are like, okay, well, I prefer not to pay Uncle Sam $100,000 of the $500,000 that I paid. Okay, or
You guys
I
didn't hear
used,
from us. Pay Uncle
yeah.
Sam, okay? Don't get locked up.
Instead of paying that, they'd rather pay the higher interest rate because at the end of the day, the math makes more sense for them to pay a few $100s a month than for them to put in $100,000 to pay off Uncle Sam just so that we can get that income to get higher. So every loan has its uniqueness. There's a reason for that. Okay. This one we don't do. The no
Yeah.
credit one we don't do.
Yeah, read the fine print before you actually utilize this loan. If you could find a lender that's giving it out, okay, that's what I recommend. But let's finish watching the video and then we'll read some of the comments from the video.
And so if you have 12 months of rental history, you've had a year of, cell phone bills and insurance bills, you can use that, and real people will actually look at your financial situation to approve you for a mortgage. Actually,
Exactly what you said.
Right. So when he says real people, okay, the real people that own this lending institution.
Yep, that's what they meant. Look at this first comment. You don't even need a loan anymore. Just squat.
For real.
Oh no, don't squat. Did you hear in Florida, if you squat, you would get locked up now. Doesn't matter. No
Good.
questions asked. They passed it. Isn't that crazy? Isn't that so
Good.
cool?
Yeah, it
If
is so
you
cool.
Yeah, you will get fined, I think up to $1,500. And then if you do it again, you will also get locked up. It's considered a felony now.
Here's the thing. If you do something wrong, if you commit a crime, you should be in jail. Sorry. Not sorry.
Yeah. Oh yeah, this person mentioned NACA can also get you a mortgage by using your income, and your credit score is not used during the loan approval process. I've helped somebody with NACA before. I'll tell you guys this: if you guys are using NACA is a longer process, especially in a very competitive market like we're seeing right now in Sacramento, California, because NACA, they're very strict on their approvals.
Yep.
They require a approved inspector to inspect the house, and then, which is no issue, and then everything that you do, you have to upload it to the NACA portal, and then the agent that's helping you buy the home has to also be NACA approved. Okay. Yes, I am NACA approved. You go through like a little small course and you sign up. But yeah, that is a process. NACA loans take a while. They're very strict. I'd say, man, just for personal experience, it's probably one of the most frustrating loans I've ever seen my clients go through, especially as a first time home buyer. You're already very overwhelmed. Now you're going through this process of a NACA loan. The program is so good for the borrower, but
Yeah.
the journey is so frustrating for the buyer too, because they're overwhelmed. Not only that, you have like one person, a middleman, that you're always keeping in contact with. And in California, there's only one person handling thousands of clients in Northern California. And man, it is sometimes so difficult to get that person to respond back in a timely manner. And imagine in a market like this, to where you have contingencies, time is of the essence, you might end up getting served a notice to perform before you even do your inspections or anything like that, because they just take a while. So you really have to be lucky, and you really got to find a seller that's willing to really be accommodating and understand that it is a NACA program. So generally for a NACA program, I'd say instead of it being a 30 to 45-day escrow, make it a 60-day escrow.
60 to sometimes even 90 and sometimes even longer,
Yes.
Tia. So I used to work for a company. We were NACA approved as well. I looked at the guidelines. The debt to income ratio is much lower. Like Chia said, it is a lot more strict, okay? Income requirements and whatnot. And it just was not worth it for me to continue to be licensed for the NACA program. And this is probably the reason why there's only one loan officer. There's only two, one, two, whatnot. I've had so many clients who were so frustrated with the NACA program, and I showed them a different way to do this. You know, hey, let's tweak this a little bit. Let's work on your credit a little bit more. Let's do this a little bit more so that you can actually get a house, right? And she was right. NACA is actually a really good loan, but the process is so excruciatingly painful for many people that it actually comes out to be better if they just, you know, go to a regular FHA program and work their way up on that.
Yeah, and remember, NACA, nothing against NACA. They're a great program for buyers, first-time home buyers. I feel like it's probably more preferred in the buyer's market where it takes a typical longer time frame to close on a home already. So sellers are already kind of conditioned for that. Right now, where homes are being gone in 20 days, 7 days, and all that, sellers
Yeah.
probably gonna look at it and be like, "Oh, I got more options than choosing from Manaka." You know, unfortunately, that's just the nature of the beast right now. So be aware of that, okay? Naka is great. It's just not for everyone, and not a lot of sellers will entertain it, especially in this market that we see right now.
Absolutely, because the seller's also looking to buy another property. So if
Yep.
they're like, they don't know whether or not you're going to be able to close in the time frame that they need in order for them to secure the loan on the other side, then it's harder for them as well. It's not them being discriminative. It's them, you know, trying to protect their own interests too.
Yep. So you gotta look at it from both ways.
Yeah.
I'm a mortgage underwriter. A manual underwrite requires only through FHA, but you have to find a lender that does manual underwriting. It's not that it is not that easy. I worked a lot for companies that don't do those loans because there are not a lot of investors on the secondary market that will buy those loans. So we should have stated what lenders do those loans. So he should
Correct.
have, which is
Correct.
true.
Correct. And that is the reason why many lenders do not do this no credit, because there's not a lot of investors that will buy this, and it's just going to sit there.
Yep. All right. That's that for this video. Did you have a topic you want to share, Lisa, before I go on to the next?
No, go ahead and go on to the next. I was excited because you said, you know, you're sharing quite a few, and I didn't want to take up more time.
Okay. So I'll share another one then. Okay, this one's gonna be a little different, but I guess it's kind of good to talk about, right? Okay. God. I think this is what a lot of buyers are feeling right now.
I'm never going to own a house.
Here's a fun fact about how broken our system is. I can't own a house either. Despite owning 2 successful businesses, I live in my parents' basement. There's a
Aw.
fun fact about me. And don't get me wrong, that's not from lack of trying to buy a house, but they make it incredibly difficult nowadays. First, start a business after university, and they say, oh, you need 3 years of business income.
Do you need 3 years of business income?
Two, and
Two,
sometimes
right?
one.
Not sometimes one, right? That's what I thought. Sometimes one.
So if you own your own business, okay, and you've owned it for less than 5 years, then they will require 2 years worth of income. If you had it for more than 5 years, then typically it's one. But also it depends on your credit. The better your credit is, that's the compensating factor that I was talking about earlier, guys. Okay. And it also depends on the type of business as well. Unfortunately, restaurants and nail salon owners, okay, have the harder time, especially because, you know, we're barely out of COVID for yes and no, right? COVID still exists and everything like that too. But we get fraud reports all the time. And most of the fraud is happening in the restaurant and the nail salon industry.
Wow.
So they are going to be a lot more strict.
Let's continue on.
Cool. Stay in business for 3 years. Go to reapply, and they say you had ups and downs. You need stable income. But businesses grow. They have up and downs. That's how it works. So I give myself a small, steady income, and then they look at things like, oh, you got your pickup truck. You have too much debt. You can't buy a house with this level of income. They say, oh, you don't need 5% down. You need 20% down because you're a business owner. Do you know how hard?
You don't need 20% for a business owner.
So he's right on a couple of things. First off, he really needs to talk to a mortgage strategist who would have told him that beforehand, okay? If you are a business owner and your expenses are on your business side, like your truck and everything like that, is in your LLC. If you are a sole proprietor, get yourself an LLC. Put all of that in your LLC and it won't count against you, guys. Had he known that, he'd be like, oh, okay, I should have done that. And that wouldn't have counted against him. If he was talking to a mortgage strategist, they would also tell him, like, hey, basically the bank just wants to know whether or not you can afford this loan, right? At the end of the day, they just want to make sure that they're going to get the return back from you. And if your business is not stable, and I get that. Chia and I, we're entrepreneurs too, okay? We're self-employed as well. And if you're not showing that consistency and everything like that, they're going to be like, well, what if you do have a slow year? Then you're going to lose your house anyway. If that were to happen, that's not in your best interest. That's also not in the bank's best interest, right? And if you're doing your business well, yes, there are ups and downs and everything like that, but those ups and downs shouldn't be like so extreme that is going to be questionable. You can't be making $500,000 a year and then also the next year only $20,000. Something is funky there. Okay.
Yeah,
But if you're
something's
making
got to give. Yeah.
something's got to give. Now, let's just say, for instance, if you're making $500,000 one year and the next year you're making only 400 because it is a slower year. Okay, they'll take just that $400,000 year, even though you require 2 years. Okay, but they will only average out that $400,000 a year. So you can still get a loan. Probably not the $2 million house that you're looking at, but maybe a smaller starter home. So I want to see him finish this.
All right.
hard it is to save up 20% of a house. So despite paying off all my trucks, saving up 20%, it is still incredibly difficult to buy a house because the house prices are going up faster than I can save the 20%. And they say this needs to be done because it's the affordability. Despite running 2 businesses, they don't know if I can handle the finance of buying a house. Don't worry, you can buy an $80,000 pickup instead, $0 down.
I'm never
Pause it, Chia. No, as
Yeah.
a business, you don't have to put down 20%. It depends. Most of the time, okay, you can actually do the FHA or the conventional loans. If you're a first-time buyer on a conventional loan, 3%. If you're not a first-time buyer, it's 5%. If you're FHA, it's still 3.5%. I think what he probably didn't get enough information from whoever the lender that he's trying to get a loan with, or he probably did it online and they just crunched out whatever he put in, and his debt to income ratio doesn't allow him to put a lower down payment, and the purchase price that he's purchasing requires that for him to put 20% down for that debt to income ratio to match. So
Yeah.
what I said earlier was FHA allows you to go all the way up to 57%. Conventional allows you to go up to 50%. So if they're calculating the math and doing that math problem for him and showing like, hey, your income's not showing enough, so you have to put 20% down for it to go down to 50%. I hope that makes sense for you guys.
Yeah, the reason why I want to talk about this with you is because people will automatically watch this video and assume, oh, I'm never gonna be able to buy a home now because I'm in the same boat. No,
Yeah.
you're probably not in the same boat. Everybody's situation is unique. We don't know. He didn't show any of his finances, of what they went off from, what was his DTI, his credit score, the type of home he's planning on buying. They need to go over all of that so that you can compare apples to apples. You that are watching this might have a better credit score than him. You might not have a business, or if you do, you might be smarter about your expenses and your deductibles. You might be putting a different down payment. You might be buying a different home, So talk to a loan strategist, a loan officer, somebody like Lisa, to budget and go over all of this. Like we've said it here many times, some of our clients that come to us to buy a home, sometimes we've been planning and working and coaching them for years before they bought their homes already. And then it becomes special for them because they remember when they first came to us years ago and weren't qualified. We have plenty of clients like that, and it always starts from there. You have to talk to a loan strategist so that way you're not second guessing the process from TikTok videos like this, because there's a lot of these out there and it can be really misleading and it can make you feel like, oh, you're never going to be able to buy a home. That is not true. Your situation is different. Talk to a loan strategist because it's a complimentary meeting anyways. We're meeting with me and Lisa, we're meeting with somebody this weekend, and they just have questions about the process. We'll meet you guys. We're not gonna bill you for the hour like an attorney's gonna do that. It's complimentary. This is our livelihood. This is what we do. We just love to educate people and to get them on track, whether they use us or not, to buy a home. But that's just part of the business.
I find it funny because there's so many TikTok experts on here, right? But it's fun to see this. It's like, oh wow, that's what's going around and circulating, right? I personally, I don't have a lot of time to be on social media and whatnot, so this is kind of cool that I'm seeing this. Now, Chino, you're asked a really good question. Why can't we just bypass the bank and take over a seller's loan and finance their equity? So here's the thing. You got a lot of legs going on because the bank who actually holds that loan for the seller doesn't want to always do this. And this is the reason why. And typically when you're assuming somebody's loan, okay, it can only be a government loan right now. It's either FHA, USDA, or VA loan, okay? So let's talk about that. So typically when you have those types of loans, you're only allowed to have it once at a time. So the seller may not want to do that because if they're a VA, they're giving up that right to have that VA loan, okay, to you, and therefore they can't use that VA for another property.
Yep.
Make sense? Okay. Same thing with FHA. Okay. Then let's just say, for instance, when the bank gives you does a loan, especially the ones that hold their own money, okay, they limit their credit line. Their purpose, most banks will want to sell that loan so they have more a credit limit.
So
Think of it like kind of a giant credit card, okay, guys? They want to pay that off so they can do more. And they're not going to want to not sell that because that interest rate that they earned was 2 to 3%, and you want it. That's great, right? You want it. But they don't want you to take over because they want to open that line again and sell it at that interest rate that it is right now. They're earning more, right? That may or may not be the case because right now with interest rates being higher, the margin of what the bank actually earns may actually also be very, very minimal because they're saying it's like, well, we can't have the margin that we used to have when the interest rate was 3%. So there are some lenders that if the margin is good enough, they will consider that. Okay. You still have to go through the same qualifications. It's not all of a sudden, hey, I want to take over the seller's loan. Let me do it. You still have to go through all the qualification process.
Not just that, but you mentioned before too that some banks don't even want to be second in lien. They want to be first, right? So imagine, Chinu, imagine you're trying to take over somebody's equity, assuming, right? Because that's what a lot of gurus are talking about right now, assuming a seller's low rate loan.
Yeah.
First of all, let's just give an example because we've mentioned it before. We're doing it again here just so everybody right now could get a refresher. Let's say you're assuming a loan of $200K, but the home is worth $500K.
Yep.
You think the seller's gonna sell it to you for $200K? No, they're not. They're gonna sell it at market rate, which is $500K. So what's gonna replace the $300K equity because you just assumed a $200K loan? You have to get a second loan, a second lien. And most mortgage companies will not want to be second. Correct, Lisa?
Yes. So most banks, especially if the second is bigger than the first to begin with, the reason why is if the house ever gets foreclosed upon, the first lender that was on that lien will always get first dibs. And when I was doing this back in 2008, okay, there was a lot of second lenders that got no money back whatsoever. The most I've ever seen the second lender ever get back was probably less than 10% of what was owed to them. So you're not going to see as many of those anymore, okay? And when you don't see that, that means, hey, you want to assume the loan? Sure. I just had a very similar situation where a client of mine had the funds to do 50% down anyway, okay? And when we crunch the numbers, it makes sense. And then when they asked the sellers, the listing agent to ask the seller whether or not it was going to be assumable, they had a conventional loan, and conventional loans are not assumable. So it was a no-go anyway.
And let's just say you did find a lender that's willing to be second in line on title, right? They gave you that $300K. That $300K is going to be based off of today's rate. So you're paying two loans with two different rates. One's at, let's just say, 2.8 during the good old days, right? And then the
Yeah.
300K loan is at 7%.
Yeah.
Like, is that gonna be okay with you? So many times when we talk about this with first-time home buyers or even investors that's planning on assuming somebody's loan, they don't see that because gurus don't talk about that portion because it doesn't sound good enough, and people's not gonna click on their links to download their book, their lessons, their mentorships and coaching programs, so they don't talk about that. They leave it out. Most of the time, what they're referring to is you're assuming the loan and buying it at that assumable price or lower. It doesn't really happen if you're assuming a loan in a home that's on the market and they expect market value and they only owe probably less than what the home is worth. They're not going to give it to you for less than what it's worth. They're just going to put it on the market. If you can't assume it, then great, just get your own loan, you know? Or
Right.
like what Lisa said, you have the cash to pay the difference, which most first-time home buyers do not have. I mean, we just showed you guys a video of a person that was complaining about how the bank was requiring him to put 20% down. It's already hard enough to save 20%, 5% down. And that's the truth. First-time home buyers, it is challenging, especially in today's economy, to save up to that percentage. So imagine paying the difference by assuming a loan. It doesn't always work. When it sounds too good to be true, double check the facts with your local expert and make sure it's doable before you get too excited.
Right. And that's the other thing that you're going to run across too, guys. Okay. Because if your second loan is pretty big, okay, and especially if it's bigger than your first loan to begin with, now you think the first lender is going to allow you to assume their loan, knowing that, hey, if anything were to happen, okay, if you don't pay your second loan and you pay your first loan, the house still goes into foreclosure. So now the first lender is like, wait a minute.
Yeah.
You owe me. You say you want to owe me, but then you owe this guy and you owe him more than me. They're not. They're gonna accept that.
Yeah.
So they're not gonna accept that assumable loan.
That's exactly what it is. Let's read some comments from this video real quick. The system is designed to keep us as peasants forever. Apparently, it's okay for me to pay $2,500 a month in rent, but not the equivalent for a mortgage. I hear people talk about this all the time. Lisa, what are your
Yeah.
thoughts on this? I'm
Yeah.
affording a $3,000 rent. How come I can't afford a $3,000 mortgage?
Yeah,
Or
I know.
qualify?
It sounds so silly, you guys. It's because when landlords look at your debt to income ratio, right? Many landlords don't like it if your debt to income ratio is above 30%. So you would think that, hey, well, these are the lending requirements. Well, this frustrates me too as a lender. I understand. I was like, hey, if this person has been making their rent for the last 2 years, I really honestly think the guidelines should be the compensating factor is like, well, they're coming up with it somehow, somewhere, right? Obviously. But the lending institution doesn't take a look at it that way. Keep in mind too, guys, okay, that the landlords may not, even though they say it's 30% debt to income ratio, they might not look at a full scope of pictures. Most landlords would do a soft credit pull. So they may not see all of the debts that you currently have. That's one. The second thing is too, is that when you got qualified to get in the rental income, did you buy your car at that time? Was your income exactly the same? Did you have a job change? And even if you're hauling and you're able to make those payments and everything like that, when your circumstance changes and the lending is looking at, oh, here's the situation. When you're renting, you're not loaning from your landlord. You're just paying him so for him to pay back his loan. So it's a less risk for them to do it that way. But when you're loaning from an actual bank that's giving you whatever money that you're needing, if you default on that, now their investment, they're not going to get that return on investment that they were hoping for.
So
Okay.
otherwise, if you don't pay, the seller gets, a bad credit score on his background because he's not paying his mortgage company. Most likely,
Correct.
he probably has a mortgage loan on that rental too. So the
Yep.
risk is all on the lender's side. Think about this. If the home breaks, it's all on the lender's side. I mean, not the lender, I'm sorry, the landlord's side. You know? So, yeah, there's not. That's what I always try to explain to people that ask me this specific question right here. I'm paying a $2,500 a month in rent. Why can't I just get a mortgage for that amount? Well, let's just say you can. Let's just say lenders do give you a loan based off of $2,500 a month. Are you gonna be okay with that type of home in today's
Yeah.
market? You know, so like that's something to consider too, because right now for a $2,500 home, let's say you're just putting the bare minimum of 3.5% down based off of today's interest rates. In Sacramento, you're probably buying a home that's a 2-bedroom, 1 bath.
Mm-hmm.
You know, so everybody's situation is gonna be different. Rental is typically a little bit lower than a mortgage payment, but long term, it's cheaper to own a home than it is to rent. So you got to look at it like that. You know, everybody's situation is going to be different, and you gotta like
Yeah.
what we mentioned earlier,
And
you gotta plan. Go ahead. Did you say something?
mm-mm.
Can you hear me, Lisa?
Yeah, I can hear you fine.
Okay. Yeah. So talk to a loan strategist to see why this is not applicable to you. But we do get asked this a lot. Let's go about this. It's not broken. It's working exactly like they planned it to. There's a reason for everything, y'all. The really screwed up part is there are people who would hear this and still say, you just need to work harder. Society is insane that we all collectively accept this nonsense.
So yes and no. I see where they're talking about, because they're thinking, oh, it's like, yeah, you can't get a leg up and everything. So let me give you an example, guys. Okay, when the market fell the last time, when the lending institution was a little bit loosey goosey, all right, and everybody and the mama, if you had a social security number, you basically was able to get a loan. What happened? What happened to that economy, right? I mean, I know it's been some time and everything like that, but every other house was on foreclosure. I have lived through that time where you can see grass growing and everything like that. Every other house on almost every single neighborhood was foreclosed upon, because here I'm doing the math for you guys. Okay, let's just say somebody's making $100,000 a year. That means on a monthly basis they're making roughly about $8,333. Okay, and let's just say they did save up that 20%. Even if they're buying a $500,000 house, okay, or let me see here. Okay, let me see what they would qualify for. 575. Okay, that 50% debt to income ratio allotment. They buy a $600,000 house. Okay, with property tax, insurance, the whole shebang, it's $4,000. Again, I'm going to go back to that number. They gross $8,333. Okay, Uncle Sam already takes about 25 to 30% of that. So I'm gonna do the math. 8,333 times 70% of your income you get to keep. So you get to keep 5,800, roughly 5,800. Your mortgage is $4,088. $4,088. You got $1,700 left to work with. Let's say you're an average American household. Okay, you're the sole income owner. Your wife stays at home to take care of the children. Okay, or one spouse stays at home, takes care of the children. Is $1,745 enough for you to make a car payment, to get food, to get gas, to get diapers, to get that, all of that? Is that enough for you? So if I divide that by 4, 1,745, if I divide that by 4, you get to spend $436 every single week. You're not saving anything at all. So the reason why these guidelines are set in place, guys, is to not set people up for failure. The system, I get it. Somebody said in the comment here, the system is broken, it's rigged, it's set to keep us as peasants, and so on and so forth. Yeah, home prices are increasing. They're increasing because people continue to see the value of home ownership. They continue to see the value of home ownership more now because of all of the social media, every bit of knowledge and information that we're getting. Unfortunately, many of it is wrong on TikTok or on the internet and whatnot, right? But I'm sharing with you, it's not to a point where it's there. The reason why it's there is because what happened the last time where everybody was able to get a loan, they did not care, or they didn't have strict guidelines to state that, oh, okay, well, I mean, if your take home is only like, $6,000, it's cool, we'll get you a loan. Your mortgage is going to be $6,000. You're cool, right? You're going to make a promise to us that it doesn't matter what happens, you're going to be able to make it, get a second job, get a side gig, whatever it is to make it by. That in itself is broken. That's what happened in 2008, and that's what they don't want to happen now. And that's the reason why it's like it only seems broken, is because unfortunately the income, our pay, even the minimum wage has raised, everybody else's income didn't raise. And everybody else was the one that's supposed to be the consumers buying the goods in order to keep this type of situation. Now, if
Oh, we just lost you there, Lisa.
hello.
Oh, we just lost you. Okay, I'm hearing you again.
Yeah, sorry guys. But see, my point was just, it's like now the consumers like me, we don't eat out as much anymore, and that hurts.
Yeah.
That hurts minimum wage people, because now it's like instead of hiring 3 people in a joint, they're only hiring 1 person. So yeah, that 1 person got that $20 an hour.
Oh, it's happening again. So we kind of get what Lisa's saying here. Something's going on here, internet. But let me just share this last comment from this video, and then we could close this live stream up. Okay? Yeah, Lisa is definitely going out. Okay, so this person said thinks that's effed up. I got my mortgage in 2015 when the mortgage rates were incredibly low in 2020. I tried to refinance but couldn't get approved because I had changed jobs and hadn't been at my current one for 2+ years. The system literally thinks that I was at risk of not being able to afford a cheaper payment on a house I was already paying for. Yeah, when from what I know, oh man, I wish Lisa was here to answer this, but from what I know, okay, when you change jobs, they do require that the new job is 2+ years because they don't really have a trusted income consistency history yet. Because they don't know if that job is gonna uh take you out from probation areas and fire you or replace you. So they don't know that. So that's why they won't give you the refinance approval, because they're afraid that if they do that, then they're gonna have to go back to their new lender or investor that's buying the loan and say that, hey, look, this person already has a mortgage, but they're looking to refinance. Let's give them a new loan. It's kind of harder to sell because, but they just changed jobs and they haven't been there for that long yet. Like it's really hard. So again, like what I was saying earlier, all of these rules and policies that banks have, it's kind of put in place because it's either this or '08 crash again, where everybody was living in their cars, and I remember that time. My mom and them had a mortgage on their house, and they had a refinance, kept refinancing just to get the payments low enough to where they could survive. And then when the rates became, a little bit more affordable and more feasible, they refinanced to a fixed rate, out from a adjustable rate, because everybody was buying adjustable rates during that period. And thankfully they were able to stick it through and sell the home, like I'd say 3-4 years ago, in today's economy. and made money from it and get equity from it. So everybody's situation is different, but I will say this, like it is tough. It does seem hard, but that's why you gotta just talk to a loan strategist similar to Lisa and just plan this this roadmap, right? This your unique roadmap. Plan it with the loan strategist and it just be coachable. Have them coach you on what you need to do, and then from there you guys could decide. Oh, Lisa's back.
Sorry, go
Hey,
ahead.
missed you.
Thanks. Sorry there, guys. Hopefully I got my point across before I got disconnected.
But yeah, no, yeah, I think you did. I think you did, because it's pretty self-explanatory. Rules and regulations and policies and guidelines are kind of put in place to prevent a big rehab from happening again. So the same thing with getting a mortgage. Unfortunately, I know that sometimes it seems unfavorable at times, because you know for the individual that feels that way at that time, maybe it's because it's telling them something bigger about their own situation.
Yeah.
But every person that's bought a home, like in today's society, whether it's high market or low market, they would tell you they worked hard to get their home. They worked hard to get approved for a mortgage. They had to pay down debts. They had to get their credit scores up. They had to do this and that. So it's not like how it used to be in 07, 08. Because even today, I'll talk to like a person that bought during that phase, and they will be like, man, why is it so difficult to get a loan right now? Because it is a lot more difficult to get a loan right now because of what happened in 07, 08. And during that time, they didn't make it strict like today. And that's why the market crashed and pooped the way it did. So they're trying to prevent that from happening again. People learn from their mistakes. And that's why right now, despite what gurus are saying about the market crashing, that's why we don't see a market crash, market correction, any of that, because everything is still going strong. So, all right, y'all. I'm gonna let y'all go. We've been over the hour. Enjoy the rest of your Thursday. But we will see you guys next time. Thanks for all the comments and thanks for watching the show. If you guys are watching again for the restream, don't forget to like, subscribe if you haven't already to the channel, and then share this video as well. Okay. Thank you, Chi Chi fans. You guys take care. See you guys next time.